Hello everyone, welcome to Koenig Heritage Let's Talk About, and today's topic is the future of real estate. A lot of questions getting asked, what's going to happen in the future to real estate, and we looked through the membership and of course found one of the greatest minds, Mr. Rob Rayner. Rob, thank you very much for joining us today. Most of you already know Rob and probably already invested with him in the past, but to those who don't know Rob, how about you give a brief introduction to the membership who don't know you?
Sure.
It's probably a small percentage.
Sure.
And your background, how do you even get to real estate? That's an interesting story too.
Thank you for those very kind words. Look, my background, for those that don't know me, I'm the CEO of a business called RF Corval. RF Corval is a property funds management group. We primarily focus on commercial and industrial property in the unlisted space. So we don't do anything in listed markets. All of our stuff is with wholesale, high net worth investors, family offices, etc. But a bit about me, I chartered accountant by qualification, did that for 3 years from about late 87 through to 1990, and I was fortunate enough to get an opportunity to move into a group in Perth, which is where I'm from, and I've sort of really been involved in real estate ever since, having built and sold a number of businesses. And the current business, RF Corval, as I say, I'm the CEO of it, a shareholder in it, along with a couple of other very close friends of mine, one of which is Andrew Roberts, who is the Roberts family of Multiplex Constructions. Andrew's a close friend of mine, a good supporter of our business, and we started our business back in 2009 with some really simple objectives, and the primary one was to just get real estate right, buy real estate as well as we can, add the value, and then look to deliver solid returns and sell the real estate at the end. And that really involved from one or two syndicates with retail investors to then family office, wholesale investors, institutions, including the likes of the Future Fund, Victoria Funds Management Corp, Funds SA, a number of large offshore family groups and institutions, and the business has really galloped on since. So we've bought and sold, my best guess would be something around about $2 to $2.5 billion worth of real estate. Currently today we manage about $1 to $1.5 billion worth of real estate. We're a small, nimble business with about 15 people who are all very, very good people, and it's a business that I'm super proud of. I enjoy going to work, and the relationships that we have with investors and capital is critical. So that's a bit about me and our business, but perhaps back to you with what questions you want to throw over. So.
Thank you, Rob. And again, to those of you who watch at home, I bet you 95% of you already know Rob, if not invested with him in the past. And it was important to me to bring Rob here and ask him a few questions I'm sure you have in mind about real estate, and I do as well. And thank you very much for your time.
Sure,
and we can explore it. I think let's start from the top up, and we'll start some general questions, then we'll go to slightly more details. What the hell happened? How does COVID-19 impact real estate? I mean, this is a bit crazy.
Sure. Well, I think it's it's an obvious question. It's a question we ask ourselves a lot. It's something that we didn't see happening or coming. I think in our industry, everyone have been talking about this black swan event, what's going to correct markets, whether that be real estate, equities, bond markets, and I guess our black swan event is this thing called COVID-19. It's happened. I think back to sort of Christmas of last year, New Year's Eve, and the bushfires were raging, and I think we're all pretty concerned, in fact very concerned on the eastern seaboard what was happening with those, and then really this COVID-19 thing was just starting to work its way up in allegedly parts of China in early parts of January, and then we sort of saw it and heard about it, but didn't really think too much about it, and then it just gathered more and more momentum, and here we are. So I sort of think back to about middle of March is when we were still working in the office, and then things got really serious, and then as a firm we then started working from home from middle of March through until we're now back in the office. So we came back mid to late June, so we had about 12 to 13 weeks, and that was interesting from a work from home experience, which I know we'll talk about a bit later. But COVID-19, it's real, it's serious. None of us know what the solutions are, none of us know where it's going to go. How much are we further into the middle, or are we coming out of it? I don't know. I thought probably a couple of weeks ago that maybe we were coming out of it, but the events in Victoria have shown that this thing is going to continue to have waves moving forward, and my personal view is I think we're going to live with COVID now for years to come, and hopefully there's medication, or even better, a vaccine, but in a worst case scenario, a medication that will allow us to operate as a community and come to work and be around each other and socialise and do things. But the bottom line is, and there'll be a recurring theme with what I'll say, is there's a lot that we don't know, but it has fundamentally changed real estate. No doubt it's changed many parts of our lives, and that's something we're working our way through, and we're starting to get our thoughts around what it may mean and stuff. But yeah, this is really serious. I was on the phone only an hour or so ago with some people in the US, and they just went into California, went down a lockdown last night. Complete lockdown. Everyone worked from home. Everything's closed. And we're seeing what's happening in other parts of the world. And Australia's in relatively good shape, but we still feel as though it's something that's around our ankles, and we're going to have to just learn to work around with it. I think for some time. Yeah.
I think the interesting part, and again, to those of you who don't know, and most of you should know, obviously we are long-term thinkers. We are fundamentalist investors by nature. We don't do real estate, but as you know, we have in our membership, like yourself, Rob, people who are quite experienced in real estate, like yourself. And when I first met Rob, I liked you have a long-term thinking on real estate, right? So I presume a lot of this upturn and downturn is not something that, obviously it's difficult, but in the long term it's not something that should rattle you if your foundations are set to you just need to adjust over the long term. Is this something you agree with? Or?
Yeah, no, totally. Look, our sector of the investment universe being direct real estate, it's really hard in the sense that we, unlike dealing with a very liquid asset, whether that be an equity investment or an investment in bonds or cash, and I guess a bit like what your main game is, investing into private equity.
It's exactly the same, right? Yeah.
But I guess our business is even harder in the sense we've got this thing called stamp duty, which is 5 to 6% of your purchase price goes out the door day one. You put some gearing around a structure of say 40 to 50%. That stamp duty impost is about 10% of your equity goes day one. Real estate assets, big assets that we buy and sell and manage, are inherently in the main illiquid assets that take some time to buy and some time to sell. So we can't, unlike liquid assets, respond to each and everything that's happening overnight with messages out of the US and China and unemployment rates and consumer confidence index levels and PPI levels coming out of the US. We just got to almost see through that, which in some ways is a blessing because I think the information overload we get now in the world we live in, there's information everywhere. Right. And if we try and react and respond to each and everything,
you do mistakes.
You're probably going to get it wrong.
Yeah.
I remember when Donald Trump got elected, I was obviously concerned at the time, but equity markets have risen. They've sort of chopped around since, but we can respond to short-term things very quickly and easily. But in our game, we can't. And I sort of think, with our asset class being negatively correlated to a lot of other assets or classes like equities and bonds and other style investments, it has therefore a legitimate space in investment portfolios for clients. And a lot of our investors and family offices love the fact that we can be so non-volatile and produce good levels of regular income with an asset value that in the main has gone up. It'll be interesting to see where it goes over the next short period of time, which we can talk about in a moment. But yeah, look, it's hard it's hard and easy. It's easy to just see through it, but if you want to react to everything, you can get really caught up in it.
I once heard a phrase from Andrew Page, who was a guest on these sessions before, and he said investment philosophy should be evergreen.
Yeah.
You can't sweep and change and chop and every bit of news that you get if you have the right foundation over the long term. Yeah, sometimes you are going to take a hit. That's just the nature of an evergreen philosophy, but over the long term you are going to be higher up. And I know personally that Rob has a reputation of being incredibly patient. And a few people came to me, not now in the past, before COVID-19, said he's very patient when he does investments. He doesn't just go and buy anything under the sun.
Well,
if it's overvalued, you don't do it.
You have to be incredibly disciplined to know what your line in the sand is, what you want to pay for something, when you want to sell something, and be strong and clear in that conviction. And because managing capital, managing people's money is an obligation we take as seriously as anything in life. It's I see
Correct.
investors' capital.
Correct.
You've heard me say it before. Many of
Correct.
the people would be watching this would have heard me say it before. I see their capital as if it's my own personal capital.
Correct.
And we invest for the longer term. You have to in real
Correct.
estate. And deliberately the investors that we invest with and alongside, they're not retail investors that can get skittish and worried about this or that. They're in the main family offices, wholesale investors, high net worth investors that understand risk and return and are saying, well, okay, well, things might not be great now, but we just hold it through and get through the other side, and we do. And that's, again, what gives me confidence in our business and our model and our properties because of the way we structure our offerings without excessive levels of gearing, alongside the right levels of investors, with all the risks disclosed, and we look at stuff each and every day. And in the main, we've got it right today, and that's certainly the way I want to continue it.
Now you know why I connect with Rob very well. I can't say I connect with a lot of real estate fund managers very well, but I'm not run for a long time, and he's the first person I reached to have this discussion. Again, thank you for your time. Now, just for you who's watching, just so we define the discussion around real estate today, you're focusing on industrial, office, and sometimes retail. I know you don't have any retail today, but not residential. For the purpose of today, we're not going to talk about residential aspect of real estate for today, just not area of focus.
Sure.
If you do want us to do a session, reach out, we'll arrange an expert in that area and we'll give you the answers that you're looking for. So again, let's focus on industrial, retail, and office. From your view of the market, and obviously you have both market research, but you're also in the industry, what do you see the impact on each one of them? I think retail is pretty
it's
straightforward, but
yeah, look, each of them are going to be affected very differently.
Yeah.
If we start from the worst to the best, you've touched upon it yourself. Clearly, retail as an asset class is under enormous pressure with the whole movement to online shopping, the movement away from discretionary spending to the non-discretionary food-based spending. It's pretty obvious. I think everyone gets that. But what I also know is that retail as an asset class is very resilient. It will work its way through. It will reinvent itself in some way or some fashion. We as a firm have zero exposure to retail. We've deliberately pivoted away from that.
before COVID-19?
Since we started, since 2009.
Oh, wow, okay.
So
that was a deliberate...
So I guess if you sort of say something long enough, eventually you may be right. So now, but that said, we have a huge interest in the sector now because we think it's corrected to a point. It may continue to correct, but as a firm, there's some really interesting things we're looking at internally at the moment. We've got one fellow that's joined us who I have enormous confidence will throw up some interesting opportunities for us. So retail is going through its challenges, but then again, I do talk to some retail landlords, and the level of spending that's coming back into centres is improving quickly, which is, I guess, on the back of COVID sort of getting more under control. So it's good to see the foot traffic through shopping centres and retailers getting some turnover through. Office is probably the next one up from that. Now, office is, I think, probably the hardest one to pick from here because there's this whole discussion around where are rents going, where are cap rates or yields going, where's demand for office space going, is this work from home trend a permanent or temporary thing? So I guess I know there's some further commentary on that, so I won't bog down on that, but I think office is the hardest to pick right from here. And industrial, well, it's the weakness of retail has been the strength of industrial, with the whole online shopping. Most of the deep industrial markets in the country have a shortage of zoned land available. There's acute interest in the sector from the larger groups to develop more space on the back of the increased demand for goods. Pretty much everything that turns up, certainly at our household, things that turn up at the front door go through a shed. So it sort of does well for the sector. So I think retail's been whacked. But I have a level of confidence there's some resilience around it moving forward. Office, there's some question marks, but we're a net positive on office for the right assets, which I'll come to in a moment, and industrial's been the winner. So
Okay. So industrial is the winner for you?
Right now it has been, yeah. But then again, there's plenty of groups that we talk to and investors that we talk to as well, and you look at the returns that are on offer from industrial at the moment, they've compressed because yields have compressed, asset values have gone up, and there's intense competition for good, well-leased industrial assets. And, I guess it depends upon the risk-return profile of capital. If you're looking for a bit more of a a sort of upside type return from here. Perhaps industrial's not it. If you're looking for a more safer, secure, less volatile type return, perhaps industrial is for you. So,
it's an interesting one, and I'll pivot a little bit. So, do you see in the market the investor appetite to risk and return changing? Are they looking now to less risk, less return, or you still see a lot of opportunistic investors? I know it depends.
It's both. Yeah. It depends, and I'm sure with any group of investors, if you put 100 investors into a room, you're going to have 10 or 15 that are going to be right at that risk end at the moment. So look, the market's been smashed. I'm all in on the risk return type stuff, and there'll be other 10 to 15 at the other end that'll say, look, I'm really scared by what's happened. Give me a much lower return without the volatility, and there's probably many in between. So it's me personally, I think there's some really interesting opportunities in the space at the moment. I'm still looking to do things with capital. As a firm we are as well, so we're not sort of sitting there saying we're doing nothing, but I still think it's probably a little bit too early for us to be aggressively looking to buy real estate, because we just don't really know where it's going to reprice to, and I say that because there hasn't been a lot of stuff that's come to market and sold.
So you proceed with caution?
We're proceeding with caution. If anything, we've probably just got the pause button on for the next short while. We'd rather see some upside come into markets where other groups look to buy real estate. If they pick the bottom and we're coming in at a slightly higher price for the next asset, I'd rather give away some of the upside than to take some of the downside away, which comes back to that whole risk and return stuff for us. We're very cautious with our capital, and I don't think we're at the bottom as a general concept, but where it goes from here, I don't really know. So I think as a general, when you're in that predicament, you tend to just wait.
So in terms of opportunities, if we unpick that a little bit more with your permission. So I'm an investor in real estate. Yeah, I mean, I'm obviously heavily focused on private equity, but let's say I want to invest in real estate in this period. Where do you think and again, we don't have a crystal ball. And for those of you who are watching, none of what's said here is an investment advice. You know the spill already, do your own due diligence, get your advisors. But your own personal thought, hey, I think there may be an opportunity in X, Y, Z. Are you happy to share it with us, or is this something that...
look, I've got my own personal views. I think suburban office assets are going to be interesting because, if you take the way people work now, more people are working from home than what they ever did before, and therefore they may not want to do the long commutes into the CBDs of Melbourne or Sydney or Brisbane or Parramatta or North Sydney or St Kilda Road, etc. So having access to office space that they can still use, which is closer to where they live, hence suburban office markets, we think is a really interesting thematic moving forward. I think retail assets that have got an alternate use or a different configuration that you can use for that retail, or has a very, very high level of turnover that's like non-discretionary. So what I mean by that is, Coles and Woolworths and Aldi and not fashion, not discretionary spend, but a retail format that was large majors that are offering food type retailing with a small number of specialties hanging off it. So we're concerned about the big sub-regional model where you've got 60, 70 specialty stores. We just don't see that as being a permanent place of where we want to be. And industrial, where there's, in markets where there's infill locations, where there's a place where there's some releasing to be done. We're not afraid of industrial that has relatively short lease terms in strong locations, infill, landlocked. That's of interest to us as well. Okay. So they're probably the things that we're more focused on at the moment.
Okay. So you mentioned, and this is perhaps a left field question here, you mentioned, I mean, we love the non-discretionary element. Again, if you wonder why we connected well, here you go another example. We, as you know, you obviously know, we are non-discretionary long-term investors. And you use the word non-discretionary, I think 3 times I counted, or maybe 4. Correct me if I'm wrong here, or maybe more. And you mentioned Aldi and or non-discretionary elements of companies operating in real estate, and naturally you would go and look for those real estates. And this is a bit of a left field, but do you think maybe some funds will shift and buy only because of this environment, they will look at buying operational companies that are that have a heavy real estate base to secure both the revenue and the.
Yeah.
I know it's a bit different.
Yeah. Look, it's a really good question.
Yeah.
And it's something that we, as a firm, me as an individual, haven't thought a whole lot about up until now. But having thought about the question, it's an interesting way to access for us underlying real estate that then has a level of operational earnings around it. Now, clearly that becomes more of a equity investment than a real estate investment, and with that then comes the uncertainty of earnings that come with that. So the domain of groups like ourselves has typically been not to buy an operating business with real estate in it, and that's been more the domain of your private equity firms that, for example, we as a firm have bought a whole range of Ingham's assets off private equity owners, which was TPG at the time. So we bought the real estate, TPG sold the business, and Ingham's listed on the ASX. So we typically look to buy the real estate, not the platform with the real estate in it. But in this environment where you may have groups that are capital starved or looking to monetize part of their business by saying, look, rather than present the real estate for sale, why don't we present all of us for sale? That could well be a theme that emerges out of this. And our preference as a firm would be to probably, in that situation, look to work alongside a private equity group that may have more interested in the operating business. And
I was just going to say, we should talk after this.
Yeah, and for us to then look to buy the real estate. That would be our preferred model, because we're not in the business of being an owner of businesses with all the issues because that's hard.
It's a different ballgame.
That's a different ballgame. That's not what we do. So
it's funny because I have come across in probably the last 12 months through people who, naturally families who built a business, usually a factory, industrial side, and they in their head they attach the real estate to the business and they try and sell it as package, and they never sell it because it's very difficult to sell both. To the same buyer, right? Yeah. So we'll talk to you about it later on.
Sure.
So I think if we're talking about, call it repositioning or paradigm shift in thinking in terms of investment. Now, I think, and again, this is a bit left field. Do you think, let's say in the city, there's a lot of high rises of offices, and if we don't have a crystal ball, but in the worst case scenario that COVID starts continue for a long time, do you think some building owners will try and shift to the building to something else to utilize the capacity, whether that's hotels, actually hotel is a bad example, but I don't know, residential or something else. Do you think that will happen?
Oh, look, I have no doubt that will happen.
Yeah.
I don't think we can continue to do what we've done in the past, that will necessarily work moving forward. You will have some building owners that are forced to do that because their tenants have gone. You'll have some building owners that are forced to do it because their competitors around them are. You'll have some building owners forced to do that because of their financial position, where they just need to do something because of leverage that mortgagees are bringing to the table. So I think it's overly simplistic for us to think that what's worked in the past will necessarily work moving forward. That's not the way we look at real estate. We're constantly looking at how we can add value, reposition it, make better use of the space that we have, and I think that will be a recurring theme, and I think COVID-19 will only accelerate that. And some assets and in locations or with existing uses, they will almost cease to exist at some point. They'll need to completely reinvent themselves. But then I'm an optimist by nature. That then creates a real opportunity.
This is the optimist here too.
So that creates enormous opportunities for those that can see through what's there. Yeah. And unfortunately, sometimes take advantage of someone else's misfortune. So.
Because you touched on the shift, and you said, hey, we what interests you personally now is a suburban office space, right? As an example, right? And we are seeing the trend of working from home, and I actually hear conflicting views outside in the street. Some people say no, it won't happen today, but we will go back to a normal office environment. Some people say, a lot of CEOs think that why do we need a physical office? We can work from home. Some say we're hybrid. So I've heard every color under the rainbow. I've had opinion in terms of working from home, right? Do you think that will change how we work in the future? Is this why you're more interested in suburban offices? Or not interested, but looking at that as a possibility?
Yeah, look, I'll answer that question in a moment, but
Yeah.
perhaps if I can just, as a point of clarification, we're still very optimistic about office space in CBD locations, whether that be Melbourne, Sydney, Brisbane, Perth, Adelaide, or the Parramatta's, Chatswoods, Macquarie Park. Still very bullish on those longer term. We're just a little bit cautious on them in the interim. So in the interim, we're more thinking there might be some better value.
Which is logical.
Logical.
I mean, you have to be, right?
But in terms of your really good question, and a very fair question, is I don't know what the new normal is. What I do know, though, is that the new normal will be different to what it's been in the past, in the sense of what the work from home has shown me, having had 12 to 13 weeks of doing it at home. And fortunately, my 3 kids are adults, so it was easier for me. We didn't have to deal with the homeschooling stuff. And with our team of 15 people, most of those have got youngish kids that are going through kindergarten, primary school, high school, and the homeschooling stuff was really difficult for them. So working from home wasn't necessarily straightforward for them. But what it showed me and all of our employees and others in the industry is that we can. And that's an important learning that, therefore, moving forward, I think any responsible employer like ourselves, we want to be fair and flexible with our team of people, and if they need to work from home from time to time, the technology, Zoom, etc., Microsoft Teams calls, it's shown it can easily be done, which is a great thing. I think that's a really, really good thing. But what I also know is that longer term, I'm very much of the view that people want to be in an office. People are social creatures doing what we're doing now. We're spending time with each other, we're talking, and ultimately people, once COVID becomes more and more under control and we can come back into an office environment, let's just think through what that means. As and when things are working through with those who are in the office, whether that be the CEO, the key people, if you're not part of that and you're at home and you're just dialing in for a Zoom call or getting an email or whatever, or getting an update once a week, you're quickly going to lose touch. And people who are competitive, we all want to be part of a team environment, will find themselves coming more and more back into an office. And for those that aren't, the decision makers in businesses will probably say, well, look, if Larry wants to work from home, well, that's his decision, but doesn't necessarily meet us, our longer term objectives. We need someone that can be in the office with us, and naturally the Larrys of the world will get further and further marginalised from what's happening in a fluid, dynamic office environment. So I think it's stabilised itself that way. But what moving forward, I think, is you're going to see a permanent, people might say, you know what, once a week I'm going to work from home, whether that be one day a week or... and I think that's a good thing. That's a really good thing. It's
interesting you say that, because I personally like to work in an office. We can work from home. As you mentioned, we have the Zoom and Skype, whatever tools you use. I personally like to come to the office. Yeah, I feel it's a different zone for me in my head, and I can concentrate and then go home. The arguments I hear from both sides, and the interesting arguments, is yes, we can work from home. Of course we can. We have for the last 14 weeks, out of necessity more than will. But I hear the argument, some people say I'm more efficient at home because there's no distraction, assuming you don't have a 6-month-old baby, but you're more efficient at home. But then the downside of it, collaboration and innovation decrease because you don't have that stimulation around table. So that's an interesting...
and I think it's also very easy to fall into the trap to think that this COVID-19 thing, which let's call it for what it is. COVID has been with us for now, in Australia, in my mind, not even 6 months, probably
3 months,
3 to 4 months.
Yeah, I agree.
Okay, and we feel as though the world's just collapsed around us, and it's serious. I'm not dismissing at all how serious this is, but it's like anything. People can very much overshoot the top on things and down the bottom and get more down or up about things and what they need to be. The truth is always somewhere in between. And COVID, there will be solutions around that at some point in time. And believe it or not, at some point we're going to get back to normal, whatever that is, where we're not going to be worried about COVID per se, and we're going to get back to being busy and active and energised and doing things collaboratively as a group, and And I just don't see that the work from home is going to be supportive of that. But what I say is I still think it will give flexibility, options here and there, to know that if we need to, we can. But I think in the main, this COVID thing at some point will become more and more of a distant memory from us, and it's so far away from thinking that now, but at some point it will, right? And we think back to previous crises we've had in health issues and GFCs and stuff, they come and they go. Same thing can happen with COVID.
My father always says, people we tend to forget.
Yeah.
Once we start to go back to someone, we forget.
Yeah.
10 years from now we'll forget, right?
Yeah.
Which I guess leads me to another topic I want to explore with you. So let's assume, COVID-19 has impacted all of us, and that's why this crisis is different, right? Say global financial crisis was a financial, banking, liquidity, or whatever you want to call it, issue. COVID-19 is a bit different in the sense that it hits us on political levels, financial levels, social levels, health levels. There's different layers, right? So, and I suspect that some of those layers, whatever they are, will continue with us in the future. Which then leads me, let's assume the world goes, I don't know what normal is, whatever normal post-COVID-19 is. Do you think that the office space internally will change? For example, would we now be more cautious and have more per square, per table? I don't even know how to define it. Do you see the regulation around that changing, or the usage of a space office change?
Yeah, look, most definitely. So I think the technical phrase is workspace ratio. So basically in our industry, in the office space, it's, if you're a government employee, they typically have a bigger workspace ratio, which could be as up to 12 to 15 square metres per one employee, where if you're in a call centre, in the private sector, it might be one employee per every 2 to 3 square metres, so it's things in between. But as a general comment, again, being very generalist in my response, is that there's no question that workspace ratios are going to increase moving forward. People will need to physically sit more apart. I've heard some commentary that there'll be trend back towards people working in offices as opposed to working in their own little workstation. A lot of the big banks have situations where you come in the morning, you grab a desk, you wheel it to where you want it to work, and you sit there, and you that may change. People may need to have their own permanent space, their own permanent set of stationery, stapler, pens. They don't want to be different, sharing stationery, etc. So there's no question it's going to, I think, lead to people having more space in how they work in an office environment. So that's the plus why people will need more office space. The cross or the negative will be, come back to this work from home. Why do we need office space at all? Or indeed, if we do, let's just have a smaller amount of space and we just work in teams. So rather than having 600 square metres for 30 people, why don't we just have 300 square metres, because we'll chop our workforce in half, and one works from home 1 week, so you only got 15 people in. And again, I question how sustainable that is. People are going to work in teams week in, week out, month in, month out, year in, year out. Once we get back to being hustled and busy and the CBDs are moving along again. So there's that side of things as well. But my personal view is I think there will be a slight reduction in the amount of office space that any given company may need, because they might do away with big meeting rooms, big foyer areas, and create space where people can physically sit apart, but be a little bit more selective and think, well, we do want to have a permanent, some people at home, some people in the office. So I think my personal preference is that my personal view rather, is I think there might be a slight net reduction in the amount of office space that any one company may need. But then again, the human nature, we've got a great capacity to survive and prosper and move on and become stronger. Companies will grow. And then, of course, we then come back to more space with growth. The other very important point that's worth noting is that clearly from an office development point of view now, if you're a developer that is going to build an office building, apart from the land and the development approvals and financing and funding, perhaps the most important part of that equation is to get the tenant pre-commit for tenants to support that office development happening. I don't think I'm putting myself too far out in the limb now to say most tenants would be reluctant to commit to a new office development. Therefore, developers won't get what they need, being that tenant pre-commitment. Therefore, the supply of new office space will be pretty less than what it was, say, coming out of the ground 12 to 18 months ago. So economics 101, demand and supply. If supply is less, there will be less choices for tenants in that sense there. So I think there's pluses in the sense people need to sit more apart, and the supply of office space will be less. That's the plus for office. The negative will be how much space do tenants physically need. Where that settles at, I don't know.
And again, another left field question here. I was always, again, I'm not against the business model. I was against the way they did it. WeWork, right? And naturally, I have, I'm being polite here, a slight aversion to the high level of debts that I see in some companies. I know you're very conservative in your debt levels in real estate. But let's remove the debt issue from WeWork, which I always raise my hand against it. And most of you heard me probably rant about it 10 times a day. Do you think that business model may change?
Yeah, I without commenting on WeWork and its financial structures and stuff, but that serviced office, the optionality that brings, I tend to think that will be a winner out of this, because
a winner.
I do. I tend to think that. Take yourself with your business and a lot of other smaller businesses. They won't want to necessarily commit to large amounts of office space for longer term. They may be prepared to pay more for flexibility and nimbleness, and say, look, I don't want to commit for 5 years to an office lease, but I need space to work for the next 6 months or 12 months, and I'll work more efficiently around that. So, anecdotally, through our office portfolio, where we've got office assets pretty much through the whole country, the area that we're seeing, there are lots of tenants still looking to lease space, but anecdotally, they're looking to either extend their existing leases for 6 and 12 months or sign shorter term new leases, far more reluctant to sign longer term lease commitments. So to me, that sort of then plays back into optionality, flexibility, nimbleness. Let's just see where this ends up. And so I tend to think that sort of serviced office sort of WeWork type model, you may well find a lot of demand for that in the short term, more so than what there's been in the past. But ultimately, where it settles, I don't know. So,
because I can't imagine companies like Microsoft or Google working from home.
No.
I mean, I might be wrong, but what do you think? You should probably write it in the comments below. Do you see, I don't know, 100,000 employees working from home? Maybe, I don't know. Now, again, this is perhaps going to be a challenging question. We don't have a crystal ball. We cannot predict the future. And in fact, neither you and I ever said the future is going to be X, Y, Z. But if we did have one, what do you think is going to happen in the next 24 months or so, particularly in real estate?
Yeah, it's...
and the answer is maybe we don't know yet, right?
Yeah, look, I obviously don't know, but if I can talk about our own business, we've just had all of our portfolio revalued. Today's the 15th of July, so we have all of our assets independently valued 30 June of each year. I'm pleased to say that nearly all of our assets have either gone up in value or held. One or two have come back by 1% and 2%, those types of numbers, which is really pleasing. So I think there'll be some really good news out there for our investors that will see that with those reports coming out towards the middle to late August. But if I then sat there and think, but I do think this is more of a 30 June 2021, 2022 story, not right now. And why I say that is quite simply COVID really didn't start to bite until March. Therefore, there hasn't been a lot of evidence, a lot of transactions. Valuers have next to nothing to go on in terms of sales evidence or comparisons or leasing or rents or incentives. So that will unfold over the next 12 to 24 months. That's going to give us a better line of sight with what's going to be happening. But if I then look at real estate is valued upon two things. One, like a share or an equity price, and a P&E. In our case, the earnings is the rent, and the price is the yield. So I'm more confident on the yield with this very low interest rate environment, and most owners being very well capitalised. There won't be a whole lot of urgent sales, and people still have a desperate need for income. So with debt still freely available for now, and interest rates on that debt being very low, combined with investors looking for income somewhere, real estate still is a great proxy for income. So there will be a level of capital that will still be looking to buy real estate for the attraction of the income side. So that will hold up, I think, if anything, maybe even pull yields down a little bit, because it all gets benchmarked to the risk-free rate of return, which is government bonds, and you know, we've all seen the chart before, the gap between the yield on real estate and the cost of debt. It's probably now growing back out again. So there's probably very good arguments why the yield on real estate should come down, and all other things being equal, yield goes down, price goes up. That's the positive. The more bigger question mark is, well, what yield are you applying that to? And that's applied to the net property income. And the income is obviously driven by the rents, and I do think there is going to be downward pressure on rents, at least for the next short while. And therefore, where those rents go, and what the more, in our industry, our net effective rent, which is the rent adjusted for incentives, where they go, I think most people in our industry would accept that rents, certainly in retail and office, are going to come back a bit from here. Where they go to, and it will depend upon the market and the age of the building and the location. So you've got this seesaw effect. I think the yields, I don't see the yields softening.
Yeah.
They may hold to firm, but I see the earnings side, being the rent, coming back a bit. So where that stabilises, I don't quite know.
And then we'll conclude shortly, but you mentioned the interest rates, right? Obviously, I've never seen any interest rates as low as that since I was born, I think. You may have.
No, I haven't.
You haven't. Okay, so I feel a bit better now. The other side of the coin, those interest rates are not sustainable. That's the reality of and my fear is, and I'm keen to hear your thoughts here, and I don't know the answer, just for those of you watching. Are they just going to soar up to 14% or something stupid in the next whatever period of time because they're just not sustainable at what they are now?
Yeah,
I'm keen to hear your thoughts on this.
Yeah, look, I'm not an economist.
We don't know.
I'm not an economist, but this is my own personal view. Interest rates typically tend to be a level of, or a barometer of inflation and growth in the economy. I don't see inflation as an issue from economic inflation or price growth inflation. I'm more concerned about inflation from a stimulus point of view, and the money that's coming to the economy. And if there's more and more money chasing around the same quantum of assets, again, supply and demand would tend to suggest that prices go up and inflation gets up off the ground, and that then sort of, the RBA then tends to sort of pull that back a bit by raising interest rates. But I think we are such a long distance away from where we are now for inflation to become a big issue and therefore interest rates to rise. I'm also of the view that there's possibly even, if you look at the yield curve in this country, it is just so flat. It is incredibly flat. As a business, we're now looking to do all of our hedging again and lock in what are very attractive rates of interest on our various trusts and our properties, etc. But I've heard the whole conversation about negative interest rates kicked around.
That's right.
I
That's right.
personally don't see it, but I would tend to be more confident about negative interest rates than interest rates rising materially from here. That's just
that's an interesting one. So you say you don't think it will happen, but if you had to put a confidence, you see it going down as well.
I see rates. I think rates are going to stay with where they are.
Yeah.
But if you said to me, Rob, do you think it's more likely that rates are going to go up or down from here? I'd probably say in the short term, probably down. Yeah. But it's only because there's just so much caution out there, and there's just so much inactivity that people are sitting there thinking, well, where's it going to go? We don't know.
What do you think? Write it in the comments or send an email. Do you think interest rates are going to go up or down? I tend to agree with you. I think they have to keep it at a certain level. Yeah. Otherwise, the economy will collapse.
Well, I think if rates were to jump up a bit from here, and again, I know we've ring-fenced residential from here, but residential, it would be a very significant damage. Damage would be done to that residential sector, and therefore, consumer confidence and values in the economy. And I think the government would be very keen to as would the banks, given their exposure to the residential sector, to see that not happen. And look, consumers out there are hurting at the moment. So think the government will do everything they can to support employers, support employees, keep rates low. But yeah, interest rates rising isn't something that keeps me awake at night right now. So,
thanks for that, Rob. Now, I hope you found it beneficial. Rob, again, I'll give you a closing remark, so final thoughts before we conclude. I definitely learned a lot. I'm not a real estate investor. I know a lot of our membership do invest with you before, and we, even though you're in real estate and I'm in private businesses, we share our philosophy is fairly similar. Be patient, think long term, have fundamentals, obviously reduce level of debt as much as reasonable, and don't do sorry for the bluntness here, don't be stupid. That's the key, and take your time. So again, thank you very much for your time. Before we conclude, do you have any closing remarks or anything else you want to tell anyone who's watching?
No, look, no, I echo your same comments. Yeah. Look, we live in tricky times at the moment. Yeah. But out of the trickiness that we're in creates real opportunity, and we're a firm believer in that. We're very optimistic and excited about what the future may bring in real estate. It's a correction that has come in. I'm personally not seeing real estate completely falling off a cliff face in terms of values for the reasons we've talked about before. But yeah, be cautious, be conservative. Invest with people that you feel comfortable and confident with. Do your due diligence properly, and don't necessarily just follow the pack. Do your own thinking. Reach out to trusted people, and take a longer term view. You have to in real estate, and above all else, don't over gear, because often I've seen gearing is the thing that brings people unstuck the most.
That's right.
Put yourself in a position where you can see through cycles, and as much as anything, make sure that either yourself personally or the managers you're investing in or with rather are investing back into the real estate to make sure that the tenants are kept and increase the value of the asset, and don't just take a very short-term view on it. Take a longer-term view and be patient. And most of all, I wish you luck. It's important. There's an element of luck that everyone needs. So but yeah, that's probably all I really have to say. So.
Thank you very much, Rob. Again, some of the word just rings truth to my ear. Long-term, patient, reduce your leverage on us. I know in real estate you do need to have a component of leverage, and don't. I think the key for me is patience, especially in this time. Yeah. You just need to be confident in your investment philosophy, which proved well throughout the years, and just keep going on that. Rob, thank you very much. I hope you did enjoy it. If you have any questions for Rob, or if you want to get in touch with him, shoot me an email and I'll connect with Rob. Rob, thank you very much.
Thank you.
Thank you. See you in the next session.